Hello and welcome to this week's episode for Conservative ETF Investor. I am your host, Senior Stock Market Analyst Ken Cogliano, and this is the stock market update for February 1st, 2025. We do currently have a yellow on our stock market strength color signal, and we're going to get into everything right now. All right, today's video is going to be a full month-end video, and this is all the content that we are going to bring to you today. But to sum it up, this video is for retail investors who are trying to beat the returns of the buy and hold investor. That's what our whole channel is about, trying to beat the returns. If you're watching this video, you're an active investor who watches their portfolio and is willing to make adjustments to that portfolio to adjust to market conditions. That's exactly what we do here. We read the market, we get the conditions of the market, and we adjust our portfolio in positions in an effort to profit off of what we see happening with those market conditions. Now, with that strategy, here are some past returns for our model SPY portfolio. In 2024, we finished the year off with 37% profit compared to the buy and hold investor who was up 24%. So we smoked them by 14 percentage points. Excellent return last year, 2024. Now in 2023, not quite as good. We did 14% buy and hold, 24%. But in 2022, we did 21%, and the S&P 500 returned negative 19%, 40% differential. That's huge when you don't go down and you go up in a down year. We have the ability to do that because we are not buy and hold investors. If the market is showing signs that it's tanking, we can change things around. We can buy puts and we can profit off of the market going down. So there's tons of ways to profit in a falling market. Last week, the S&P 500 lost 1.01%. The NASDAQ 100 lost 1.39%, and the IWM small caps lost 0.97%. So all the major indexes lost approximately 1%. Now, I do have 4 model portfolios that I put out to my subscribers, but here on what you're watching now, I'm only going to share with you guys the SPY portfolio. But I do track SPY, QQQ, IWM, and I have a small account in which it has a starting capital of $3,450. And I can, in that particular model portfolio, I can trade any product that is available with Charles Schwab. So if you want to be a member and you would like to get real-time trade alerts as I put them out for any of these 4 portfolios, you can click on this link right here. It will be down in the description down below. You can see that I've got very reasonable pricing options for you to choose from. And then in 2024, you know that we had an excellent year, up 37% compared to 23%. So we have a good strategy. Takes a little time to learn the strategy, but it's a strategy that if you follow me, you can learn this strategy. Now, last week in the SPY portfolio, we did not put out any trades. I'm going to share with you my positions with that in just a second. So what happened last week? Last week, I'm going to break it down per day, and you'll see it in the candlesticks in just a moment. But on Friday, this is the action that happened on Friday, okay? You can see where the markets, the S&P 500, and a lot of the markets were green. And then the news came out about stocks giving up gains as Trump moves ahead on tariffs. So the key word here is tariffs. The market is obviously getting spooked by tariffs. What does the market not like? The market does not like the unknown. It wants to know the outcome of an event. Even if the outcome is negative, it would be better off knowing that information than not knowing it. Because when you're not knowing it and you're left to just speculate on what are the potential outcomes, you just go crazy. So, and you can see by how the market reacted after the news announcement, the market did not like it. Now, what's going to happen next week? We don't know. We don't know exactly what's going to happen next week because the market is unpredictable in those senses. We can only base our information on how to position ourselves based off of the information that we know today. All right, so as you know, we did have 0 trades sent out last week for the SPY portfolio. Now, this here is SPY candlestick 10-day chart, okay? Now, on the last trade that I did, which is over here on 122.25, I did a sell to open covered call, and I did it with a 607 strike. 607 is this line right here with an expiration date of 129.25. Well, guess what? 129.25 is that candle right there. Because that candle closed below that line, that means that this option that I sold expired worthless. So that $806 that was profitable to me, that's what I got paid to sell the 2 in the money covered calls. At that point in time, because we closed below my strike price, we kept that money, the $806, kept it in our pocket, and we kept the shares. The shares did not get taken away from us because it closed below the strike. And we just held on to our shares, and the market started to go up until Friday. So you can see on Friday, it was really starting to go up very nicely. But then that news about the tariffs came out. You can see the large downward candle that developed. And not only that, this particular candle is overshadowing the small body of this previous day's candle, which tells you that there's a lot of negative energy that was introduced into the market on Friday. So that just the size of the candle. Now, I know it's a little difficult to see because the volume bars and the candlestick on the 27th are right here, but here is the body of the candle for the 27th. If I grab from there and I kind of touch up like this, I'll get something like that. If I grab from here and go up to, let's just say right there, you can see a trading channel right here that the market was kind of bouncing in and out of. But right now we are trading below this trading channel right now. So that's kind of on the bearish side right there. So a little bit of bearish activity, but it's all based off of just one day's trading, all based off of Friday's trading. One day does not make a trend. So will this continue? That's an unknown variable right now. It may continue, and if it does, we'll react accordingly. But so far, it's just one day's worth of data that's starting to turn south on us. All right, here are the trades that we've made in 2025. Now, we started off the SPY portfolio with $130,000. That gives us enough to buy 200 shares and have 10% in cash. So this way, we're not fully invested 100% at all times. We just have at the 200 shares invested, and then that extra 10% in cash, which currently right now we've got $120,000 invested and $12,000 in cash on our now profitable $132,800 portfolio. But the point is that on that $12,000, if things start to go south on us and we're still holding these shares and we didn't take any defensive actions, we can start to take defensive actions with that cash that we have. So it gives us options on how we want to play the market if it starts going south in a hurry. So it depends upon what we see right now. So we do, as I have shared with you, this is our 2025 trades. The yellow represents open trades. If it doesn't have a yellow, these are closed out trades. And that's it. We started out the year at 130,000 and we build the year out from there. And we'll trade the portfolio according to the market data. So depending upon what the market does will determine on if we want to make any positions. As you know, last week we made no adjustments, no trades, no nothing. We held on to our 200 shares we did have an in-the-money covered call that expired worthless. We're still holding those shares because overall the market is still bullish. And I'll show you that as we go into the charts in this video. If you'd like to sign up for my real-time trade alerts, you can head over to here. I want you to smash that like button down, subscribe to my channel, and ring that bell to be notified when I post a new video. All right, now we're looking at an equity curve for our model portfolio in blue against the buy and hold investor in pink. So here you can see the two portfolios. Now our whole goal here is for our portfolio to be higher in returns than the buy and hold investor. We are below them now by a small amount, but there's a lot of space between now and the end of the year. So our expectation is that between now and the end of the year, we will surpass them. All right, here is the Fed chair. That is Mr. Jerome Powell. On January 29th, the Fed holds the rates. The next announcement is on March, oops, let me delete that. The next announcement is on March 19th. And I've got highlighted it in here, hold, because the probabilities is high that he's going to hold. Originally, he's announced he was going to do 4 cuts in 2025. He revised that to 2 cuts in 2025. Well, you can see all the dates of all the meetings scheduled for 2025. So if he's going to hold true to the 2 rate cuts in 2025, when will he make those cuts? All we know is that in the next announcement, March 19th, it's a low probability. I'll show you that in the next slide. So here you can see that there is an 83% probability that the Fed is going to keep the rates at its current value and simply hold them. All right, now we are looking at chart TNX. Now that is the candlestick chart. In the solid blue, that's SPY representing the S&P 500. In black, we have TLT, which is 20-year bonds ETF. Now, I think that we're in a trading range pretty much between here, oops, and here. So right now you can see the arrow where we currently stand right here. And I've got a symbol over here of the bears and the bulls, because this chart that I'm looking at right now is telling me that we are at equilibrium between the bears and the bulls. So this chart isn't telling me bullish or bearish information. Right now, it's kind of telling me that the market is in a neutral condition. All right, now we are looking at things from the presidential election cycle theory. And what that is it states, depending upon the year of the election, you have historical rates of return for the S&P 500 and down here for the NASDAQ 100. The current year, 2025, is the year after the election. Historically, for the S&P 500, that averages a 6.7% return for the whole year. Currently, the buy and hold investor for SPY is up 2.69%. So between now and the end of the year, there is a high probability based off of presidential election cycle theory that we're going to gain another 4%. So from that stance, we are bullish. All right, now we are looking at things from the bond market. The bond market is 3 times the size of the stock market. We were inverted for about 2 years. We currently, as of February 2nd, 2025, we do have a normal yield curve. Eventually, that inverted yield curve is going to come back to bite us, and we have to be on our toes, especially if you're a buy and hold investor, because eventually this market is going to turn south. The only question is when. I thought it was going to happen in 2025. Now I'm thinking it's going to be 2026. Just loosely from just a 30,000 elevation foot view, I'm thinking that 2025 is going to be a 5 to 6% year, exactly like that presidential election cycle theory suggested, 6-7% for the S&P 500 buy and hold investor. But next year, I'm suspecting it's going to be some type of correction in the 20% or greater range. Now, these are just really just guesses at this point in time. That data that we're seeing in the market isn't telling us that. I'm just saying based off of the yield curve, based off of probabilities, and the U.S. presidential election cycle theory. The second year after the election is usually the worst year for the 4-year cycle. So all of these things will come into fruition in 2026. So let's just take all of the information that we have right now with a grain of salt. The information based off of what we're looking at now in the bond market, you can see my symbol down here, is neutral. We are in a rising rate environment. 1 year ago, the 10-year was at 4.14. The 10-year today is at 4.55. Not by much, 4.14 to 4.55. It's still a rising rate environment, but it's not crazy. So right now, with the information that we have just based off of the bond market, we're in a neutral stock market condition. All right, here is our friend, Mr. Warren Buffett, the Oracle of Omaha, best stock market trader of all times. And over here is CNN Business Fear and Greed Index. Currently, we are in neutral. We have to compare it to last week to get a trajectory of where we're going. 1 week ago, we were at 42. We are currently at 46. So the number is traveling that way, but not by much, and we are still in neutral. In neutral, this market can go either way. That's why you see the symbol of the bears and the bulls. Okay, now we are going to look at things from a seasonality outlook. And using 5 years of past data for the month of January, there was a 60% probability in which you were going to close higher than when you opened the month. And that absolutely happened. We did close higher, 2.69% for the month of January. Here is the month of January. You can see the green bar right here. And I have in here a trading range here and here. And you can see that we've closed inside of that trading channel. And you can see that trading channel is traveling north. So as long as you stay within that trading channel, you are traveling north. Prices are going higher. Now, one thing I want to point out here is that historically for the last 5 to 30 years, you're going to get somewhere between 7 and 10% returns for the S&P 500. Currently, the buy and hold investor is up 2.69%. So based off of this historical information, the market is going to close higher between where it's at now and the end of the year. Now, let's shift our focus and let's talk about February. In February, there is a 50% probability that you are going to close higher than when you opened it. Well, that's only 50%. So it can literally go either way. So looking at next week's action based off of this information, we're kind of in a neutral stance between the bears and the bulls. Now we're going to look at the same data, but using a little bit more information. This is going back 10 years. This is going back 15 years. Let's focus on the month of February. 44% probability and 64% probability. So on one side of the coin, you've got less than 50% odds. On the other side of the coin, you've got greater than 50% odds. So with this information from a seasonality outlook, I've got it down as neutral. All right, now we are looking at this chart, which I got here off of this link. And you can pick on all the stuff that I'm sharing with you guys. There'll be links down in the description down below if you'd like to go to these web pages all on your own. If you look at this particular web page, you can see all the years going back into the 1930s. And obviously the greens represent positive years, and you can see the percentage points. Now, for some reason, they didn't put the negative percentage points here, but you can pretty much kind of guess. And I also put down for these last two really good corrections, I did put in the years. So this one is 2008. That was the mortgage meltdown, down 38%. This one in 2022, that was a drop of 19.4%. And in 2022, the reason why that dropped was because the Fed, Jerome Powell, increased interest rates so significantly. By the way, talking about the Fed, the mortgage meltdown, the Fed contributed to that because the Fed relaxed its standards for mortgages, allowing anybody and their brother to get a mortgage. If you had a heartbeat, you could get a mortgage. So people went way overextended. Instead of getting one house, they got 3 houses. And so they were way over the top. Prices just escalated on housing, and then finally everything just crashed, including the market with a 38% correction. Now, one other thing I want to point out here. Now, if I take this chart and I just kind of draw a line down the middle, kind of like this, you'll notice how many red bars there are on this side of the chart, and then you'll notice how many red bars there are on this side of the chart. And if you'll notice the length and duration of the red bars over here compared to the red bars over here, it's like a different scenario. So somewhere after 1975, the amount of corrections and the number of corrections changed prior to 1975. So just information that I'm just sharing out there. And after 1975, we really only had 1, 2, 3, pretty good size, more than about 20% or greater corrections. That's pretty incredible that you've only had that many number of corrections since 1975. All right, now we are looking at SPY monthly chart. Now that's the chart that is in black and red. Now I do have in the ribbon here a lot of exponential moving averages, just so that we can get an idea of what's going on. Now this chart is going back to 2005. A lot of data in this chart. Now look at the nice bull run since 2009. Bam, up like that. What a nice trajectory. And we are still in that nice trajectory. Look at the way, especially here in the thumbnail, the SPY is trading above all the exponential moving averages. All the exponential moving averages are on top of one another. There's no crossovers like there was here and the market coming down here, here, and here. So just from the look of the chart, that's why you've got the bull here. This is an absolutely bullish chart. But there's some areas of concern. Look down here at the MACD. Look how high your MACD level is. In going back, I went back and did this in more research than just this chart that I'm showing you. Going back to like 1993, when SPY first was introduced or thereabouts, something like that, the MACD has only been at its current level twice. Here and where it's at right now, here. The last time we were at this level, the correction that was experienced was 25.1%. So that is concerning. Are we going to experience another 25% correction? And if so, when? I mean, this is the MACD is an oscillator. It cannot continue to go up and up and up and up. It's going to eventually correct. When this oscillator does correct, like it did here in 2022, well, look at the market. The market went down. So we want to be aware of that. Technically, it would be healthy for the market to actually do that. I would love for the market to do that, and I would love to profit off of that. Because after that correction, after that MACD settled down, came through a bottom, look at the histogram, where the histogram went through a bottom, and then the slow stochastics was at a bottom, and then went north, and then the histogram on the MACD went north. Well, then look at the chart. The S&P 500 took off. At that point in time, that's what I would refer to as easy money. I don't want to make difficult money. Trying to make money in a downward moving market and get your timing really down tight, that's somewhat of a challenge, because majority of the time you can see the market does travel up. So when the market starts traveling down, you really got to be on your toes in order to make money. But after the correction, after you've experienced that 25% pullback correction, and you finally reach a bottom, and the histogram reaches a bottom, and things start traveling north, slow stochastics traveling north, and that market starts traveling north, that's the easy money. Then we can, when we make our plays, we're not just going to be buying shares of SPY, we're going to be buying options, because we can make some serious cake, the easy money, and we might as well make leveraged money at that point in time. We're not there, but we'll get there eventually. Hopefully it will happen at somewhere in 2026 or the end of 2026. But you got to realize, not every day is a day that you can make easy money in the market, especially if you're talking about the indexes. You have to wait for the timing, and some of the stuff takes a year or 2 years or multiple years in order to develop, for you to get to where you want it to be. But after the correction on the very next bull run, I plan to be there, be ready, be cognizant, and I plan to take the appropriate actions to profit off of that next bull run as handsomely as possible. And personally, that's going to set me up 100%. And I hope that you are along for the ride for that as well. All right, now we are looking at a weekly 5-year candlestick chart for the S&P 500. And in here, you can see that I've got a rising wedge with this support and this resistance. We broke down out of it right here. And I put in a projection of this line right here, a projection where we could fall to. We have not fallen to that level. We only have fallen to this level here, somewhere below 580, just below 580. And we are bouncing off of that low level and traveling north. It's still reasonable to assume, especially because you still have this negative divergence here on the MACD, where the MACD has made a lower high, but the price action has made a higher high. That still is not resolved. The MACD is below its signal line, and I wanted to look over here in the thumbnail of the MACD. Do you notice how the MACD reached a bottom, started to travel north to its signal line, but due to the negative energy, never reached it and is currently traveling parallel? If this market starts to go down, even just a little bit, that MACD is going to go and start going the other way. That energy is telling you that there is a lot of negativity, weakness in the S&P 500, and we need to start protecting our portfolio. We just don't want 200 shares naked. We want 200 shares naked with an in-the-money covered call, because there's a high probability that that's going to come down. Or we have the 200 shares and we throw on a couple of puts. We do something to start protecting our capital. Now, with the current chart that we're looking at, and we're trying to get an idea of next week, I do have the symbol of the bears and the bulls showing you neutrality. Now, if you look here at the MACD, you'll notice we're below the signal line and it looks like it wants to travel down. But the slow stochastics is above its signal line and it's traveling north. So you've got a cross current right there. So with that information, it looks like we're going to get some sideways action for the next week, hence the bull and bear symbol. So we've got neutrality here so far with this information. All right, now we are looking at a daily candlestick chart for the S&P 500 with our cycle brackets down here. 6 months is the time duration on this. You'll notice that I wrote down short-term outlook, sideways, trading range. So I'm saying that we are in a trading range now between this point right here and this point right here. Well, more likely this point right here. We start breaking that low right there at about 595, which is only 5 points lower than where we're at now. That's going to start taking us down to the next level, which is this level over here, which is around 575. Let me get rid of this. That is 575. So if indeed we break that level at about 595, we could drop down quite easily down to 575. Let's just wait and see what happens. Now on the MACD, you can see in the histogram how it's losing energy and traveling south. You can clearly see a topping pattern here where it wants to travel down across its signal line and head south. Slow stochastics is right at 80, but it is under 80, and it looks like it could very easily be traveling south. A lot of negative energy. I've got my cycle brackets here where that low is representing that low is representing that low right there. This particular cycle here, this cycle, that's a negative cycle because we opened the cycle here and we closed it way down there. The current cycle is positively configured. And not only that, it did this, the level that this came to did surpass the previous cycle's high. So those things tell me that this current cycle is a positive cycle, but we've already reached the peak. So we're in the tail end now. Now we're pulling back here. So now we're pulling back. The question is, how much is this pullback going to be? It's hard to say. The previous cycle was a completely negative cycle. So we'll see. It looks like we're going to get some, I wrote it down for you guys. It looks like we're going to get some sideways trading action happening from what I'm seeing in this chart right now. It's a ratio chart, NASDAQ 100 against the S&P 500. The ratio chart is the one that is in black and red. We are currently right here at the 50-period moving average on this daily chart, with the green is the 50-period moving average. We're right there. We did reach a bottom. I did put in a trading range with support and resistance. So we were traveling inside here. We're still traveling inside here. We did bounce off of that low created right there. So this is a risk-on environment, and a risk-on for the ratio chart is bullish. It's bullish for two indexes. It's bullish for the NASDAQ 100 as well as the S&P 500. MACD, look at the histogram. It is traveling north. The MACD is currently below its signal line, but it looks like it has the energy to travel north. Slow stochastics already above its signal line, traveling north. Again, bullish. Now we're looking at another ratio chart, equally weighted S&P 500 against the normal cap weighted S&P 500. That's the chart that's in red and black. In blue, we have the S&P 500. Lime green, we have the RSP ETF, which is the equally weighted S&P 500. Currently, you can see that the two indexes, the cap weighted and the normal equally weighted, I should say, they are both traveling in unison. You can see on the ratio chart how we have just completely gone down south, and we are hanging out down here on this very, very low range. This data goes back to 2005. This is the first time since 2005 that this ratio chart has traveled at this level. And we're still in this level. And until we break out of it, we're going to be in this trading range. And the market, while it's in this trading range, is advancing. Now, to me, the easy money to be made is when that happens right there, that happens right there. In other words, the ratio chart goes into the toilet, you travel sideways for a period of time, then you travel north. If you look at the S&P 500, that was a great time to be long. Same thing over here. The ratio chart went down into the toilet, traveled sideways, went north. Look at the blue S&P 500, went north. That's the easy money. I want the easy money so I can be on and on with leverage. We're not there yet. We're still in this trading range down here in the toilet. So, and I don't know, and look at the last two times. The last time was a 19% correction. The time before that was a 40%. That's a 38% correction I told you about. So between these two corrections, where's our correction now? It's not there yet. So I think this is the future, completely unknown. But based off of past history, it would be reasonable to assume you're going to get a 25% correction between now and that line that I told you about. That line right there, that line right there. It has not developed here. So you don't see that line traveling north like that. No correction right here. And I would think that we're going to get, by the time that line produces itself, before that line produces itself, I should say, I would be reasonable to assume we're going to get a 25% correction. It's not there yet. The market every day, it's a brand new, who knows exactly what is going to happen. It's the future. Nobody has a crystal ball, including me. So with the information derived from this chart that I can see today, I'm going to say that we are in a bullish configuration. Now we are going to look at the VIX Volatility Fear Index. And we are currently trading between this green line and this green line. That puts us in the low range, which is bullish. You can see the bull. We are in a bullish configuration. So with this information, the market should go higher. All right, now we are looking at SPY on the Thinkorswim platform, 3-year weekly candlestick chart with our cycle brackets down here at the bottom. And we do have a wedge formation that I have identified here. We did break down out of that wedge formation, and then I have a valid trend line drawn from this cycle low to there, and this cycle low to right there. I think that is right there. That cycle low could be considered either there or there, but let's just say it's right there. And with that, I drew in a line of a projection where we could fall to. So we could fall to that level right there. We're not there yet. As a matter of fact, we're not even below. I have an alert that's going to be sent to me if we breach that low, the recent low here, at 575.90. I'll be alerted by my cell phone if that were to happen. That just gives me really tight control of exactly where this market is, just in case I'm not looking at the screen at the time. All right, let's switch this over. Let's look at this on a daily basis here. Let's go to 1-year daily and change our cycle brackets to 1-year daily. And on this screen here, with additional daily cycle brackets, you have the major and the 3 minors for each major cycle. Now, this cycle is there, that one is right there, and you can kind of see the 3 highs when you do make cycle highs here. Now, in the cycle that we're at now, this low right there has not been determined yet. We do have a cycle peak here for this one, a cycle peak here for that one right there, and this cycle peak most likely is that one right there. Now, if that's true, I want you to notice how we're just slightly negative. So it didn't quite get the strength based off of this information on this Thinkorswim platform. So on this one, it's showing that it really did not make a newer high. It made it a little bit lower. So on this one here, it's showing that you don't have the strength to break out into new highs. We do have a low coming up. We're not there yet. But if we start breaking up higher, you know that this cycle low has been established, and then we go from there. And you can see the current cycle that we're at right now, that's positively configured. This is the one here that is negatively configured right here. This one here, would you go from that low to that low? That's a neutral cycle. So we went from a neutral to a negative to a currently positive cycle. I got a lot of lines here. So the cycle that we're at right now is currently positive. That low is higher than any low that has been produced thus far. If we maintain that condition, this will be a positive cycle, giving you further information that the next cycle should be positive. So we're waiting for this low here to establish itself here. It has not done that yet. So let's give it another week. Let's see what this market does. Here you can see that the MACD is showing negativity, histogram traveling south, slow stochastics traveling south. So it looks like we've got a few more days at least of downward action. So the only question is how much are we going to pull in? All right, now we are looking at an Excel spreadsheet from a chart that I created. Now this is all fresh data as of today, February 2nd, 2025. I look at asset classes, various asset classes, equities, real estate, precious metals, bonds, emerging markets. And then down here is the 11 S&P 500 sectors broken down per sector. The best number you can get on my chart here is a 6. Anything with a 5 or a 6 gets the color green. The more green on the screen, the stronger things are. 2 things we want to do. We want to see how much green is on the screen, number 1. Number 2, we want to compare last week's reading to the current week's reading. Now for asset classes, we were at 41. Now we're at 33. That is bearish. We're going the other way. We're going towards a correction, at least in various asset classes. Now let's break down to the 11 sectors. Last week, 48. This week, 38. We're still in yellow. We have to get to a 35 or less to get that color from yellow to red, but we are going in the direction of towards red. So that's of a concern that you can see weakness. So I've got the bear symbol here. So from my own personal data that I collect here with this strategy, we're seeing bearishness. All right, that is going to take us to the conclusion of this video. As of February 2nd, 2025, the market summation, according to me, Ken Cogliano, Senior Market Analyst for Conservative ETF Investor. This market is soft, as noted by the yellow on the strength signal indicator. So how do we play next week? I suspect sideways action for next week, so we want to sell option premium to get some ROI. How else are you going to make money in a sideways moving market? I did check, and I don't like the current return on investment on that trade. So for now, I'm just going to hold my current shares of SPY, currently holding 200 shares in our model portfolio, and I'm going to wait to see what the market direction is. Now, down here, I've got that 10-day candlestick chart. This is the chart that we all have. We all have this data. We all have this information. You can see the negativity here that happened on Friday. We got to see if that's going to carry through. So for now, I'm just going to hold those 200 shares naked, and I'm going to wait and see what the market wants to tell me about its direction next week. And then I'll base my trades based off of that market action. Now, even though I say all these things, the market is an 800-pound gorilla, and this 800-pound gorilla right here, he's going to do whatever he wants to do whenever he wants to do it. If you want to sign up for my real-time trade alerts, you can head over to this link right here. It will be down in the description down below. I hope you got some valuable information out of this video. If you have not done so already, I want you to smash that like button down, subscribe to my channel, and ring that bell. I thank you and wish you good trading.